You might think AI demand is a golden ticket for every tech company, but today's inflation data reminded the market of one thing: again, costs still matter. The key story today was producer prices. In January, U.S. producer prices rose 0.5% month over month, beating expectations. Services prices rose 0.8%, and trade services prices, which reflect wholesale and retail margins, also jumped sharply. In simple terms, many companies are still passing higher costs on to consumers. That makes it harder for the Fed to turn dovish anytime soon. This matters because inflation is no longer just a factory floor issue. It is spreading through distribution, services, and the pricing decisions of large companies. That is why the next key checkpoint is March 13. On that day, the market will get the January PCE report. If that report also comes in hot, expectations for rate cuts could be pushed back again. If it cools, the market may get some relief, but today's PPI report made that path less comfortable. Now let's look at AI infrastructure. Dell delivered a strong earnings report and confirmed that AI server demand is still very real. Dell posted a record $9 billion in quarterly AI-optimized server revenue, and it set a fiscal 2027 AI server revenue target of around $50 billion. The company also raised its dividend, which can be seen as a signal that management still expects strong cash generation ahead. In other words, hyperscalers and enterprise customers are still spending heavily on AI hardware. But this does not mean a clean victory for the entire hardware supply chain. The same AI investment boom is making memory supply tighter. According to Reuters and TrendForce, some DRAM contract prices are expected to rise about 90–95% quarter over quarter in the first quarter. So yes, demand is strong, but input costs are rising quickly too. Companies with pricing power may handle this better, but others, especially lower-margin PC and hardware businesses, could face margin pressure. While the market focuses on AI beneficiaries, Berkshire is showing a very different direction. Berkshire currently holds about $381.7 billion in cash and short-term investments, and it has maintained a net selling stance for multiple quarters. This does not automatically mean a market crash is coming, but it clearly shows that one of the most disciplined capital allocators in history is choosing cash and flexibility over aggressive chasing in a richly valued market. In a strong bull market narrative, that approach can look passive, but in a volatile macro environment, it can become a very powerful strategy. Credit risk is also back on the radar. The collapse of UK lender Market Financial Solutions raised concerns about exposure tied to private credit. Markets often ignore these problems until they start hitting earnings or funding conditions. A single event does not prove systemic contagion, but it can expose areas where leverage or underwriting standards were weaker than investors assumed. That is why this story matters, even if immediate losses appear contained. In fintech, Block announced more than 4,000 job cuts as part of an AI-focused restructuring. Management described it as an efficiency move. That is clearly an important margin signal. But investors should be careful not to treat every AI-related layoff as immediate proof of consumer collapse. Cost control, productivity improvement, and macroeconomic slowdown can exist at the same time. And the market needs to separate those stories instead of forcing them into one explanation. Energy is another layer of risk. Indirect U.S.-Iran talks in Geneva ended without a deal, though there was some progress and the talks were extended. Even so, oil reacted to the uncertainty, and Brent crude settled at around $72.48 per barrel. That tells you the geopolitical risk premium has not disappeared. So if we map the market today, it looks like this: hot producer prices, stubborn margin pass-through, strong AI hardware demand, rising memory costs, cautious capital allocation, and pockets of stress in credit markets. Watch the U.S. 10-year Treasury yield. Watch the March 13 PCE report, and watch whether AI leaders can keep demand strong while protecting margins. This is not financial advice. Keep your eyes on the margins. I'm Wilson, and I'll see you tomorrow.